How are you today? Are you good? I sent you an email this morning. Got it? Okay, beautiful. Okay, today's lecture is a very short and very easy lecture. If you understand the residual earnings model, today we are going to discuss another model that is similar in structure to the residual earnings model. It is called the residual operating income model or valuation model. Remember that net financial obligations are usually recorded at a value close to their market value on the balance sheet, and the market value of these debt securities, usually the market values are very close to the fair values. Why is that? If you still remember when we talked about debt securities and equity securities in the first lecture, we said that valuation of debt securities is very easy because all the inputs we need are there except the required return, right? Whereas equity, all the inputs we need are to be estimated, right? So debt securities are usually fairly priced, and therefore the recorded value on the balance sheet is roughly or very close to the fair value. Remember that these debt securities are financing instruments, and therefore usually they do not add value. Usually, not always, but usually most of the value comes from operating activities. Remember that operating income is usually generated by net operating assets, right? And net operating assets are usually recorded at historical cost rather than at fair or market value. And therefore, we can focus our attention on the valuation of the net operating assets because the reported value on the balance sheet doesn't reflect the market value. So we need to calculate the value of these net operating assets. If this is the case, we can just forecast the operating income and net operating assets rather than going down to the net financial expenses and also the earnings forecast. We can just stop once we have forecasted the operating income and the net operating assets, as we shall see shortly. So today we are going to discuss a new valuation model based on the residual operating income. There is another similar or equivalent model where we use the change in the residual operating income. This model gives us the same value like this one, so we are not going to discuss this one. We are going to focus on the first one. Remember that the value of equity according to the residual earnings model is equal to the current book value of equity plus the present value of the future residual earnings, including the plus the present value of the continuing value by the end of our horizon. Do you remember this model from lecture 4? Okay. Again, remember that financial assets and liabilities that are usually used to calculate NFOs usually are reported at market value or value close to the fair value. If this is the case, then the residual net financial expense is equal to 0. In other words, the net financial expense is almost equal to the required return on NFO, and therefore the difference is almost equal to 0. So we can drop it from our forecast when we build forecast to value the firm. So the model boils down to these components. The value of equity is equal to the book value of equity plus the present residual earnings from net assets not at market value. Assets that are usually recorded at historical cost. We need to calculate the present value of the residual earnings from these assets. These assets are usually the net operating assets. So this is the structure of the model. Remember that operating income after tax minus net financial expense after tax gives us earnings. Remember that operating income is usually generated by net operating assets. And net financial expense is the expense incurred on NFOs. You remember? Net financial obligations are the value or the net debt of the firm. And net financial expense is the expense on these net financial obligations. Okay? Remember also that net operating assets minus NFO gives us the common equity, right? And therefore, the difference, this minus this, the earnings, belongs to common equity, right? Okay. Residual operating income is just the difference between the operating income generated at time t. Here we are talking about the residual operating income at time t, okay? Residual operating income at time t is the difference between the operating income at time t minus the required return on the net operating assets, or the required income on net operating assets, lagged at time t minus 1, or at the start of the period. Okay? So here we have a product of two items. Here, row F, remember that row F, this is the required return on the firm, or on the operations of the firm. Or alternatively, it is 1 plus the weighted average cost of capital. Okay? We will discuss it in greater details, this one. Remember that row F is equal to 1 plus the required return on the operations of the firm. Minus 1 is equal to the required return on the operations of the firm. Okay? So we have here two terms. This is the operating income generated by the net operating assets, and the product here, this times this, is how much required on the net operating assets. The difference is the surplus. It could be, or the deficit, or it could be positive or negative. So the difference is the residual operating income, above or below the required return on net operating assets. Okay? We can also write down the formula for the residual net financial expense. The residual net financial expense is the difference between the net financial expense and the product of the required return on NFO at the beginning of the period. So for example, if the NFO at the beginning of the period is 100 and the required return, or the cost of net debt, this one is the cost of net debt. The cost of net debt is 10%. It means that lenders, they require 10% times 100 required return on their money. Right? That is $10. Right? Now, it might be the case that net financial expense in this case is 11. The difference is $1. This is the residual net financial expense. Okay? However, most of the time, the difference here is almost zero. The difference is almost zero. Now, this quantity, if we subtract the residual net financial expense from the residual operating income, we get what? We get the residual earnings, because this one minus this one gives us earnings. So this minus this gives us earnings. And this one quantity minus this quantity gives us the required return on equity. Right? Make sense? Okay? So residual operating income minus residual net financial expense is equal to the residual earnings. However, because this one usually very close to zero, we can drop it from our consideration. We can stop here. We can stop here when we build our forecast. So all we need is the upper line. We need a forecast of the operating income. We need a forecast of the net operating assets. Once we have done that, we can calculate the residual operating income. And once we have calculated the residual operating income, we can value the whole firm. We can value the whole firm. And once we have valued the whole firm, we can easily value equity by subtracting the net debt from the value of the whole firm. Okay? Value of equity is equal to the value of the whole firm minus the value of its net debt. Make sense? You are familiar with this relation, right? You know this equation. Okay. The residual operating income sometimes is called EVA, or the economic value added, or economic profit. Again, the residual earnings, or it might be better to write it residual net financial expense from NFO, are usually expected to be zero. If this is the case, then the value of net debt, is equal to the reported book value of net debt. Remember that NFO is the net debt of the firm. On the balance sheet, we have the reported book value, and in the market, we have the observed market value. On the balance sheet, most of the debt securities are usually reported at market value. So the reported book value on the balance sheet is similar to the observed market value of these debt securities. Okay? Most of the time, usually. Okay? So they are almost equal. And because they are almost equal, again, the residual net financial expense is almost zero. But net operating assets, remember that net operating assets are operating assets minus operating liabilities. Usually, these items are reported at historical cost on the balance sheet, so they do not reflect the market or the fair value. So we can focus our valuation on these net operating assets. Accordingly, the value of the net operating assets is equal to the initial book value of net operating assets plus the present value of the expected residual operating income plus the present value of the continuing value at the end of our horizon. Similar to the structure of the residual earnings model. Okay? If you understand that model, this model is much the same in terms of the structure. Okay? You remember the residual earnings model. According to the residual earnings model, the value of equity is equal to the initial book value of equity plus the present value of the future residual earnings plus the present value of the continuing value at the end of our horizon. You remember? This is the same structure. This is the initial book value of net operating assets plus the present value of the residual operating income plus the present value of the continuing value by the end of our horizon. Okay? We calculate the continuing value at the end of our horizon, this one, and then we discount it to the present. This continuing value, again, we have three cases similar to the cases discussed under the residual earnings model. Case number one, continuing value is equal to zero. This is the case if you believe that the residual operating income after the horizon will be zero. So we have here our forecast horizon, and in the future, beyond our horizon, we believe that residual operating income will be zeros after the horizon. If this is the case, then the continuing value is equal to zero. Okay? And if you believe that the residual operating income will be constant every year after the horizon, we use this formula. This is the perpetuity formula. It is equal to also, we can write it like this, residual operating income at time t plus 1 divided by the required return on the operations of the firm. Okay? Remember that the required return on the operations of the firm is the same as the cost of capital, weighted average cost of capital. Are you familiar with this concept, the weighted average cost of capital? Got this concept? Okay. We will discuss it shortly to refresh your memory. And case number 3, if you believe the residual operating income after the horizon will be growing at a constant growth rate, normally we use here the long run growth rate, the growth rate that is sustainable, can be maintained. Most of the time we use the long run growth rate of the GDP. Okay? So it becomes the residual operating income at time t plus 1 divided by the difference between the cost of capital and the growth rate. If you wish, we can write it like this. This is the required return, or the weighted average cost of capital, minus the growth rate. The same cases discussed in lecture 4. Very simple. Any questions? Okay. This formula gives us the value of the operations of the firm, and also at the same time it is the same as the value of the firm or the enterprise value, so, or the value of the whole firm. Okay? So when we apply this formula, we get the value of the whole firm, okay? Or the value of its operations. Remember also that common shareholders' equity is equal to the difference between net operating assets and NFO. If this is the case, then the value of equity is also equal to the difference between the value of the operations and the value of the debt. We have already seen how to value the operations of the firm, so we plug the formula for this one here. From here to here is the value of the firm. From this formula, we plug this formula here. And we already also said that NFO is also a good proxy, or almost equal to the value of NFO. So we plug the observed NFO on the balance sheet, we plug it into the formula as a proxy for the value of NFO, because they are almost equal most of the time. Okay? And then we reduce the formula, because this one, net operating assets at time 0 minus NFO at time 0, gives us this minus this gives us the book value of equity at time 0. If this is the case, then the value of equity at time 0 is equal to the book value of equity at time 0 plus the present value of the future residual operating income, as well as the present value of this one is a typo, remove this one, the present value of the continuing value at time t. Okay? This extra plus sign is a typo, I'm sorry. Make sense? Very simple. So we can value equity using two methods or two ways. Either we value the operations using this formula, and then we subtract NFO to get the value of equity, or we use this formula straightforward. This one will give us the value of equity. Okay? Very simple. This is an example. Our beloved firm, Nike. We befriended this firm since The start of the semester, it has been with us, huh? Nike assumed that its cost of capital in 2010 was 9.1%. We are now here. Actual, A means actual, E means forecast or expected or estimates. Sometimes we use F instead of E. It means forecast, okay? A means actual data. So this is the actual net operating assets at that time, and these ones are estimated or expected net operating assets, and these are also the expected operating income. Now to calculate the residual operating income, this is the first residual operating income. We apply the formula. The residual operating income at time t is equal to operating income at time t minus the product of the cost of capital, RF, multiplied by the lagged net operating assets at time t minus 1. Accordingly, this one can be calculated as 1950 minus the product of the cost of capital, 0.091 times the lagged net operating assets, this one, 5514. We do the same for every year, okay? Once we have calculated the residual operating income, don't forget also to calculate the continuing value at time t. Here, it is assumed that after the horizon, the residual operating income will grow at a constant growth rate equal to the growth rate of the GDP, the long-run growth rate of the GDP. So we take the last residual operating income, this one, we multiply this one here, this one, the last one. We take the last one, we multiply it by 1 plus the long-run growth rate, and we divide it by the difference between the required return and the growth rate, and this gives us the continuing value at time t by the end of our horizon. We still need to calculate the present value at time 0. So we divide the continuing value, this is the continuing value, we divide it by the 1 plus r to the power t. How many years we have? 1, 2, 3, 4. So this one is equal to 1.091 to the power 4. Okay? This one is to power 3. This one to power 2. This one is to power 1. Okay? Make sense? Okay. So we divide this one by this one. We get the present value of the continuing value. We divide this by this, we get the present value here. We divide this by this, we get the present value of this one. We divide this by this, we get this one. This by this, we get this one. Then we take the sum. This is the sum. And then we sum them together. This plus this plus this gives us the value of the firm, or the enterprise value. Now there is a little trick here in the road, is that this firm in that year had net financial assets rather than net financial obligations. That's why, as you can see, that's why we add this to this rather than subtract it. So this is the value of equity. We add this one plus this one. If this quantity was net financial obligations, we subtract it. But it was net financial assets, so we add it. Okay? We add. Make sense? So it becomes this one. This is the value of equity. Once we have calculated the value of equity, we divide it by the number of shares to get the value per share. Okay? Make sense? Make sense? Okay. Very simple model, similar to the residual earnings model in terms of the structure and the build-up. Okay? Do you have any questions? We can finish in 1 hour, by the way. Would you like to have a break? So this is the formula. This is the formula. Remember that this one is 1 plus the required return on operation. If you subtract 1, you can reduce it to RF, okay? It becomes RF. Note that this formula for the residual operating income can be written as follows. How to do that? Just divide both sides, this side and this side, divide it by the lagged net operating assets, and you will get this formula. Okay? I will write it for you. Divide both sides here. Okay. Note that operating income at time t divided by net operating assets at time t minus 1 is the return on net operating assets. Okay? Minus. Okay? Now, you can, once we have this one, now it becomes residual operating income at time t. Just multiply this quantity by the right-hand side to calculate the residual operating income at time t. It becomes okay? Make sense? So this is where this formula came from, okay? Remember that the required return is usually constant, but this one is variable and this one is variable. So these are the two drivers. These are the two drivers of the residual operating income. And also note that when we calculate the residual operating income to value the firm, we should focus on the core operating income. Okay? Because core operating income are the items used to calculate the core operating income are sustainable, expected to repeat in the future. Okay? Unusual items should be excluded because the expected value is 0 and they are not expected to repeat in the future, so we can drop them from our considerations. If you include the unusual items, in this case you may get a distorted value of the underlying stock. Okay? So we need to focus on the core. Okay? Would you like to have a break? No? Finish and go home? Okay. Okay, let us talk about the cost of capital for operations. Operations of the firm, usually they have their own risk. Sometimes we call this risk operational risk. Sometimes we call it firm risk or enterprise risk. Sometimes it is also called business risk. Business risk. Okay? This risk arises from the factors that affect the operations of the firm, such as the fluctuations in the demand and supply, forces of competitions, blah, blah, blah. All of these factors, they do affect the business and the operations of the firm, right? They are beyond the control of the firm. This risk determines the required return or the cost of capital to invest in the operations of the firm. This cost of capital is sometimes called weighted average cost of capital. Why is that? Because we take into consideration the weight of both debt and equity in the calculation? Sometimes you will see a formula like this. Okay. In other standard textbooks of finance, it will be like this. The weight of equity divided by the capital of the firm. Here we use the value of equity, the market value of debt, and we use the value of equity, multiplied by the required return on equity, plus the value of debt relative to the total capital, times the required return on debt, times 1 minus the tax rate. 1 minus the tax rate. Okay? Why is that? Because interest on debt is tax deductible. So we multiply the nominal cost of debt by 1 minus the tax rate to calculate the after-tax cost of debt. Okay? So this is the weight of equity, the value of equity relative to the value of both debt and equity. So the sum here, this is value of debt plus the value of equity. The sum is called the capital of the firm. So the value, the weight here is the value of equity relative to the capital. Okay? Multiplied by the required return on equity plus the weight of debt. The weight of debt is the value of debt relative to the value of the whole capital, multiplied by the after-tax cost of debt. Okay? Remember that this one, I know that it is a little bit annoying, but this is how the author decided to write these symbols. I'm very sorry. This one, remember, it is 1 plus the weighted average cost of capital. And this one is 1 plus the required return on equity, and this one is 1 plus the after-tax required return on debt. This is 1 minus T, okay? Okay, so remember, the after-tax cost of debt is the nominal cost of debt times 1 minus the tax rate. And the cost of equity, rho minus 1, is usually calculated using the CAPM model. It is the most popular model used to calculate the cost of the equity. This is an example. Assume that the risk-free rate is 3.6% and the market risk premium is 5%. Remember that the market risk premium is the difference between the expected return on the market portfolio and the risk-free rate. Okay? So the market risk premium is the difference between the expected return on the market portfolio and the risk-free rate. Now the beta, let us talk about, for example, General Mills. It has a beta of 0.4. This is the equity beta. Therefore, we can apply the CAPM model to calculate its cost of equity. The cost of equity is 5.6%. This one is calculated as follows. 3.6%, this is the risk-free rate, plus the product of the beta and the market risk premium. 0.4 times 5%. 0.4 times 5% gives us 2%. 2% plus 3.6% is 5.6%, okay? The after-tax cost of debt is 3.3%. Accordingly, we can calculate the cost of capital for this firm as follows. We take the value of equity, this is the value of equity, and this is the value of debt, and this is the value of both, this plus this. So we divide the value of equity by the value of the firm here. So this is the weight of equity. The value of equity divided by the value of the firm, multiplied by the cost of equity, plus the value of debt relative to the value of the firm, multiplied by the after-tax cost of debt. And this gives us the cost of capital for this firm. Okay? We do the same here for Nike, but because the firm had net financial assets, this weight becomes negative rather than positive. Okay? This weight becomes negative rather than positive. The weight of debt is negative because the firm had net financial assets rather than net financial obligations. Okay? So this is where the 9.1% came from. If you go back to the former example, this is the one we used in the calculations in the former example. Here. Okay? So the cost of equity can be calculated using the CAPM model. Alternatively, the cost of equity can be derived from the cost of capital for the operations if known in advance, but not vice versa. To see how to do that, rearrange the former formula for the cost of equity. We can write it as follows. The cost of equity is equal to the cost of capital plus the product of value of debt relative to the value of equity multiplied by the difference between the cost of capital and the cost of debt, or the required return on debt. Okay? This is the 1 plus the required return on debt. Okay? Note that the value of debt relative to the value of equity, if you still remember, financial leverage is equal to NFO divided by CSE. This ratio is also called book leverage. Book leverage. Okay? Because we take the book value of NFO divided by the book value of equity. There is another form of leverage. It is called market leverage. So this ratio is the market leverage. It is the market value of debt relative to the market value of equity. Here, when we talk about debt, we are talking about net debt, okay? Be careful, okay? So it is the market value of debt or net debt relative to the market value of equity. It is called market leverage. As we can see, equity risk here, this one is a typo. It should be equity return or required return. The required return on equity has two components. The first one, this is the first component, and then the second one is the additional return due to financing risk. The whole term here, this quantity times this, is the extra return because of the use of leverage. This means note that this one is called market leverage, as I said before, and the difference, this minus this, is the spread. This means that if the firm doesn't use leverage, in this case, the cost of equity will be equal to the cost of operations, or the required return on equity is similar to the required return on operations. This is the case of a pure equity firm. Once we start using net debt in the operations of the firm, shareholders will start demand extra return because of the increase in risk, because the use of debt will increase the risk, right? So this is the extra return. This quantity is the extra return demanded by shareholders as the firm starts using debt and increasing debt, okay? Make sense? So if there is no net debt, then this one is equal to this one. Once we use debt in our operations, we start demanding extra return to compensate us for the extra risk borne by the shareholders, okay? Now compare this equation, compare this equation with the equation for the return on common equity. Compare this one with this one. The return on common equity is equal to the return on net operating assets plus the book leverage. Remember, this one is the book leverage multiplied by the operating spread. Okay? Note that this one is the required return on equity. This one is the required return on equity. This one is the return on common equity. So the difference between this and this is equal to what? Don't tell me you do not know. The difference between the return on common equity and the required return on common equity is the residual or abnormal return in percentage wise rather than in dollar terms. If you multiply the difference by the lag book value of equity, you get the residual earnings in dollar terms. Okay? Make sense? Okay. And this is the return on net operating assets, and this is the required return on net operating assets. So the difference between this and this, assuming that this one is after subtracting 1, because this is 1 plus the required return, assuming that we are talking here about the required return on operations, the difference between this and this is the residual operating return rather than profit, because profit means in dollar terms, but return in percentage terms, okay? Make sense? Okay. And this one, the difference between this and this is equal to what? This quantity and this quantity. Come on, don't tell me you do not know. Okay, I will leave it for you to think about it. Okay, now have a look at the two opposing effects. Look at the two opposing effects in these two equations. Under the required return equation, the use of leverage, if we increase the leverage of the firm, the required return will increase, or shareholders will demand extra return to compensate them for the extra risk, right? But under this equation, as we increase the leverage, the return on common equity also is expected to increase, provided that the difference here is positive. So we have two opposing effects. Once we increase the leverage, the return on common equity will increase. This is true if the difference here is positive, but the required return also will increase. So which effect dominates, or what is the net effect? The net effect here, a standard notion is that the two leverage effects, they are exactly offsetting each other, leaving the value of equity unaffected. So they are expected to offset each other, and this will leave the value of equity unaffected. This is true under certain conditions. Because if we increase the leverage, but this one, the difference here is negative, in this case, the increase in leverage will increase this one, but this one may go down. So under certain conditions, okay, so be careful. So let us see this example. Residual operating income valuation of a firm with 9% cost of capital, and the after-tax cost of debt is 5%. Assume that we have the following hypothetical firm. It has the following net operating assets at time 0. It means now. It is here we have dash or NT. So it is expected that this one will be constant every year. The same applies here. NFOs are expected to be the same every year. The same applies here. This is just to simplify the calculations, okay? because the focus here on something else. Operating income also is expected to be constant every year forever. The net financial expense expected to be constant every year, and it is calculated as NFO times the cost of debt. So this is the net interest expense or net financial expense. The difference between this and this is the earnings. Note that residual operating income will be constant every year. So the first one is calculated as 135 minus the product of the cost of capital, 9%, and the lagged net operating assets. We do the same every year. If this is the case, then the present value of the residual operating income, we just divide the first one by the cost of capital, and we get the present value because every year it is the same. So we just use one of them, we divide it by the cost of capital, and that will give us the present value of this perpetual stream of residual operating income. So we have here a perpetuity. We just take the first one, we divide it by the cost of capital, and this is the present value of all the expected residual operating income for eternity. Okay? Make sense? Okay. Once we have calculated this one, we add it to the equity at time 0, and we get the value of equity. So this is the value of equity. We divide it by the number of shares, we get the value per share. Okay? The value relative to the book value, this divided by this, is 1.2. Now, if we calculate also the return on common equity, this divided by equity, we get how much? 12%. And if we calculate the earnings per share, 120 divided by 600, we get 0.2%. Okay? Now we can alternatively use this one and the former formula to calculate the cost of equity and value the firm using the residual earnings model. If we do that, we will get the same value. Okay? Very simple. All you need to do, just calculate the residual earnings for the first year, divide it by the cost of equity, and then add it to the initial book value of equity. The sum, or the present value of the perpetuity, is added to the initial this book value, and you will get the same value here, similar to the residual operating income model. Okay? Now let us see if the value of equity will change if the leverage of the firm is also changed. Assume that the firm borrowed $400 and repurchased 200 shares at the current value of $2 per share. In this case, the net operating assets remains the same, but the NFO increases from 300 to 700. This is the initial NFO. If we borrow 400, then NFO will increase to 700. Equity decreases from 1,000 to 600. Why is that? Because we bought 200 shares. And so we have now how much? How many shares we have? Initially we had 600 shares. We buy back 200, and in this case, we have only 400 shares. Okay? Let us see what happens if the firm did something like this. Okay. Note that if you value the firm using the residual operating income discounted at the original cost of capital, the 9%, you still will get the same answer. Similar to the answer you get if you use the residual earnings model. Okay, So if we want to value the firm using the residual earnings model, the first step we need to do is to calculate the cost of capital. This is the cost of capital. It is equal to the cost of operations plus the weight of equity times the difference between the cost of capital and the cost of debt. So this is the new cost of equity. We need also to adjust the leverage of the firm. It is now 700 rather than 300. We need also to recalculate the new cost of debt. We multiply 5% by 700 rather than 300. Okay? And we need also to calculate the new earnings. This is the new earnings. Note that this one remains intact. The expected operating income every year remains intact. The change happens to what? To the net financial expense and to the earnings. Okay? Make sense? So, the new return on common equity, this one is just the earnings divided by the lagged equity, by this one. We do the same every year, 100 divided by 600, because this one is expected to be the same every year. And the residual earnings every year is constant, 25. This one is calculated as 100 minus the cost of equity times the lagged value of equity. It is constant every year. If we divide this one by the cost of equity, we get the present value of the stream of residual earnings. Add this one to the book value, we get 800. This is the value of equity divided by the new number of shares. We get the value per share of $2. Okay? Note something. After this change in leverage, we have to do a lot of calculations, new calculations. We need to calculate the new cost of capital, equity capital. We need to recalculate the new financial the new net financial expense. We need also to recalculate the earnings, blah blah. At the end of the day, we'll get the same value obtained if we use the residual operating income model. So, if we use the residual operating model, we can save ourselves all of these extra calculations after the change in leverage. Okay? So this is the beauty of this model, the residual operating model. Even if the firm changes its leverage, we do not need to do new calculations. We can focus or use the residual operating model, value the whole firm, and after we have valued the whole firm, we subtract the new level of leverage. We subtract the new level of leverage to get the value of equity. Make sense? So we do not need to do all of these extra calculations. We can save ourselves the time. So this is a new step. We need to calculate this one, and new calculations here, and extra calculations here, and blah, blah, blah. We can get the same answer if we use the original residual operating income. It was how much? Initially, the residual operating income was 18. The present value of the stream of residual operating income is equal to 18 divided by what? The cost of capital by 9%. That is equal to 200. Add this one to 600 and you will get 800. The same answer. Okay? Make sense? So we can save ourselves a lot of time and calculations. Note something else also here. After the change in leverage, this one, it was before the change, it was 1.2. So after the change in leverage, the value to book ratio increased. At the same time, the return on common equity, now here it is 16.2. 7%. Before the change in leverage, before the increase in debt, the ratio was how much? 12%. The earning per share here is how much? Divide 100 by 400, and it is 0.25. Before the change in leverage, the ratio was how much? 0.2. As you can see, we have an increase in the value to book ratio. We have an increase in the return on common equity. We have an increase in the earning per share, but still the value per share, the value per share remains intact. Okay? So this is one method that is sometimes used by firms in practice to fool the market. Okay? There is no change in the value of per share or the value per share. But these indicators improved. We have an improvement in this ratio, we have an improvement in this ratio, we have an improvement here, but still there is no value added. Okay? So a naive investor might be fooled by something like this, may push the price up or buy the stock at a price higher than the true value. Make sense? So you need to be careful when you see something like this. This is one way that is sometimes used by firms to fool the market. So, and this is true, there is no value added if the shares are bought at the fair market value. In this case, there is no value added. Remember that in the former example, the firm bought back 200 shares at the fair value. If the firm can buy back the shares at less than the fair value, in this case, okay, there is a value added. That might increase the value per share. Okay? So if the firm buys back the shares at a fair value or at a price equal to the fair value, there is no value added. If the firm can buy back at less than the fair value, there is value added. If the firm overpaid or bought the shares at a price more than the value, then there is a loss of value. Okay? So managers in practice, or firms in general, in practice, they repurchase. Repurchase shares means sometimes it is called buyback. Okay? Buyback. Buyback shares or repurchase shares. In order to pay out extra cash if they have surplus cash, sometimes also they do it in order to reverse the dilutive effect of stock options. You remember stock options? Firms in practice, sometimes they grant options to their managers or employees. If the holder of the option decided to exercise, in this case the firm is obliged to issue new shares. Now issuing new shares will increase the number of shares outstanding, and this will reduce the earning per share. So what should the firm do to reverse the dilutive effect? By buying back some shares. In this case, we can reduce this effect. Okay? And also to increase the earning per share, this is related to this point. Sometimes also to actively time the market. Time the market. So if the firm believes that the observed market price is less than the fair value of the stock, in this case, it is a good time to buy back the shares in order to push the observed market price up to the fair value. Okay? Sometimes if the firm believes that the market price is greater than the true value, this is a good time to what? To issue shares. So we have two decisions, to issue shares or to buy back shares. We buy back shares when we believe that the market price is less than the true value. We issue shares if the observed market price is greater than the true value. This will add value to the shareholders. Issuing shares at a price greater than the true value will add value to the existing shareholders. Make sense? Okay. So, the advantages of valuing operations, remember that in this, when we use this model, the residual operating income model, we can ignore the financing activities from the forecasting. We can focus only on the operations. All we need is a forecast of the residual, of the operating income and the net operating assets. Remember to use, we need to use the core operating income. Also, we do not need to do recalculations or recalculate the cost of equity and the new net financial expenses and the new earnings, blah, blah, blah. We just need the initial cost of capital and the expected operating income and net operating assets, okay? Even if there is a change in the leverage, we do not need to worry, okay? Finally, there are also some ratios that are used to value the whole firm. These are the multiples, similar to the multiples that are used in the valuation of the stock. Here, these multiples are used to value the whole firm. So, the first step is to select or to find the comparable firms, and then calculate these ratios for the comparable firms. Let us say that we find 5 firms here, comparables, and comparables to whom? To our underlying firm. We calculate the ratio for each firm, then we take the average, then we multiply it by the relevant figure of our firm. This will give us the value of our the value of the whole firm, of our firm, okay? Once we value the whole firm, we subtract the value of net debt to get the value of equity, okay? There are 2 versions for each multiple. The first one, this one, we use the observed market price. This is the market value of equity, the market price, and the market price of net debt relative to sales, for example. Alternatively, we calculate the value for each firm, comparable firm. This is the value using the formal model. We divide it by sales. We do that for all the comparable firms. Then we take the average and apply it to our underlying firm. Okay? We do the same here. We do the same here. Remember that net debt is debt obligations minus debt assets held by the firm. Okay? So again, these ones to the left side, this one is using the market value or the observed market price of equity and debt. The same applies here, and here. Okay? Here, on this side, we use the calculated value using the formal model. We value the comparable firms using the formal model, the residual operating income model. Okay? And we do the same here, and here. Okay? Make sense? Similar to those used to value the stock. But here we value the whole firm. Again, once we value the whole firm, we value its equity by subtracting the value of net debt from the value of the whole firm. Okay? Very simple. This is it. Any questions? Any questions? Okay, remember, please, you have a RAT test tomorrow. Remember also, I sent you an email this morning. You remember some students, they complained to me because some other students or members of their groups, they are free riders. This is not acceptable. If someone is under contributing, please still keep his name or her name in your group, but give him or give her what he or she deserves on Spark. Do not drop the name out, okay? Keep the name there, but give him what he deserves on the Spark, okay?
Yes,
Because half of the annual dividend, because half of the annual dividend already paid in the past period, from June 2018 until December 2018.
yeah.
Already half of the annual dividend already paid. Firms and writers, they normally pay dividends on quarterly basis. We are simplifying the calculations here by assuming that they are annual.
Oh, okay. Because my question was going to be, do we need to split up dividends into discount and semi-annual basis? So we're just discounting them in
The
an annual
problem
basis?
is that if you want to do that, you have to calculate also the semi-annual return. You can simplify it. Calculate the annual dividends and discount it to the present, except the first one. Take half of it because half of it already paid in the first half of the year. Again, it is more accurate to do that. So more accurate, more faster. Confuse management. I will highlight this one.
Thank you.
There's a little way. I'll show you something. For example, for example, there was an amount of we can combine this going and also from here to there, our interim dividend, we will do 2019. If there is an interim dividend, this one, we combine it with this one here, and then we discount the sum to the benefits. Doing something like this is more accurate, but that will confuse the students. I don't want to make it very difficult. Just keep it very simple.
I think we have to decide how to this lecture, anything we just spoke about. Yeah.
I'll see you later. Yeah, but here the 5% cost of this is already an after-tax basis.
Another question is about the sign. When we calculating the EPS, the early 90s. You give us the EPS growth rate, right?
但是你刚才我这么想的一个问题是，就是那个折算到一定的之后，就是意味着
Did you read my previous answers to the assigned queries?
Yeah.
Did you read them?
Yeah.
Okay, so we use June 2018 EPS to forecast June 2019. So I already gave you this one. So you multiply this one by 1 plus the to calculate this one.
But this one, can we use the EPS growth rate in focus?
The what?
EPS on January.
No, because January to June will give you half the year. We need the annual growth in dividend in the earnings.
So this part we have to search the financial statement and
If you take the EBS in 2019 and multiply it by 1 growth rate, that will give you the expected EBS in December 2019. Okay? Because the growth rate given to you is the annual growth rate.
yeah, and
So if you multiply it by EBS in 2019, in January 2019, you will get the EBS in December 2019. This is not what relevant to.
if this is 1 and the growth rate is 5%, this is half year, right? Can I calculate this use?
Besides, this is the half year EBS. This is half year. Why are you doing that? Why will you make it difficult? Just take the June EBS in June 2018, multiply it by 1 plus the growth rate. You get the June 2019 expected EBS.
No,
That's
I
it.
need a January.
Why you need the January? You do not need it. What for?
The first valuation, you know, the PE multiple, you need to get.
Okay. You can use the expected one in June 2019 and multiply it by the average price to earning ratio.
So this one is the average of.
You can use, take the average price to earning ratio, multiply it by the next June 2019 EBS, okay? That will be it. Or the most recent one. The problem is that you are talking here about if you use the January or December EBS, this is a half year EBS. You should use the annual. You multiply the price to earning ratio by the annual EBS. Either you take the EBS of June 2018 or June 2019. Look forward, better. Use the expected EBS in June 2019, okay?
So, I just wanted to ask, in the exam, are we expected to produce like a table like this? You know, like knowing which value, which calculations are below each other and drawing out the years, for example?
Do not tell me you cannot do something like this. Where is the problem if I ask you something like this?
Oh, well, just like between the various models, you know, like which variables we are using. You know, because like the values
It will be simple. It will be simple. This is something that is very intuitive. Shouldn't be a drama for you. You should be able, for example, I may give you forecast of operating income and net operating assets, and I may ask you to calculate the residual operating income and value the firm. You should be able to do something like this.
Oh,
It is very simple.
okay.
Okay?
All right.
Very simple. Just understand that you will be fine. Don't memorize, understand. Okay?
Okay.
The formulas will be given to you in the exam. Just understand how to apply them.
All right. Thank you.
All the rest.
Just a question.
Yeah, sure.
Valuation analysis for PHP company. So why do you want to do some research? We like brief information and also like fundamental information about that company, or I need to reference from online or their official website. So in our
Just
assignment,
put beneath any borrowed info, put the source, the annual report of PHP. That's it.
that's
That's it. If you have from Yahoo Finance, put source Yahoo Finance. That's it.
in the assignment. Do we back check similarity with different sources, or I mean, will we check similarity of the assignment or not?
Yes, be careful.
Yes.
Don't copy from each other.
Oh, we want to copy. I mean, if we use the source from online, so
we check. Be careful. Don't copy anything exactly letter by letter.
if we use
Just
as a
borrow,
reference.
borrow an input.
Yeah.
Borrow an input.
Yeah.
If you want to borrow, for example, there is business description. Okay. Do not copy paste from the annual report letter by letter. No, you should write it in your own way.
Or
Okay.
use our own one
Yeah.
to instead. All right. Thank you.
Most welcome. See you.